Welcome to This Explainer. Today, we're unpacking a massive mystery that has absolutely frustrated countless people in the financial markets. We're looking squarely at why beginners in Forex trading fail. And surprisingly, it's almost never from a lack of technical knowledge. Instead, it's a series of hidden fundamental mistakes that most traders don't even realize they're making.
So let's just address the giant elephant in the room right off the bat. You've spent hours studying, right? If you know exactly how to spot an order block or identify a change of character on a chart, why is your account literally still bleeding? The technical knowledge is there, but the application is falling apart. We need to figure out what's causing this huge disconnect between knowing the charts and actually protecting your capital. To do that, we're going to break this down into 5 fatal account killers, tracing a path straight from the charts into your mind. The early entry trap, probability jar blindness, the expectation deception, the indicator overload, and finally, the market mirror. All right, let's kick things off with number 1, the early entry trap, entering at the setup, not the confirmation.
Now, the big tactical error happens right here. On the left, we've got the classic retail entry. A beginner sees price hit a point of interest and bam, they execute the trade immediately. Why? Because they have this intense fear of missing out on the move. But over on the right, you see the professional approach. While amateurs execute out of pure FOMO, pros demand that the market prove its intent first. They just wait.
Because here's the thing. The market often creates these perfectly good-looking setups purely to trap early retail traders. Price will sweep right through their stop losses, grabbing all that liquidity before finally giving real confirmation. You know, like a lower time frame shift in structure or a change of character where the trend officially flips. Only after that institutional intent is confirmed does the pro actually enter. Simply put, if you jump in at the setup, you are the liquidity.
Moving on to number 2, probability jar blindness, or what we can call the mathematical blind spot.
Professional mastery really comes down to viewing every single trade as just one random draw from a jar filled with red and green marbles. If you have a solid winning strategy, you know your jar has, say, 60% green marbles and 40% red ones. But, and this is absolutely crucial, you never know which color you're going to pull out on any individual turn. It's completely random.
And because of that randomness, pros know a loss is literally just the cost of doing business. It's just a red marble you have to pull to eventually get to the green ones. Beginners, they don't see it this way at all. They treat every single trade like a life or death event. So when they inevitably pull just 2 completely normal red marbles in a row, they panic. This leads straight to shiny object syndrome, where they completely abandon a perfectly good strategy to go hunt for a new one, resetting all their progress back to 0.
Which brings us to number 3, the expectation deception. Those totally unrealistic get-rich-quick illusions. We've all seen the fake gurus on social media, right? The ones showing off luxury lifestyles and driving supercars in Dubai or Miami. Driven by that, beginners jump into the market chasing 100 to 200% annual returns. They honestly think they can flip $100 into 10 grand in a week. But that expectation is the exact brutal truth behind why accounts get destroyed. To even attempt those numbers, you have to over-leverage, meaning just one bad trade wipes you out entirely.
Conversely, look at this number right here, 20%. Professionals understand that a stable 20% annual return is the true standard of long-term wealth. To put that into perspective, if you can make a consistent 20% annually, you're actually outperforming 95% of all professional hedge funds in the world. Once you align your expectations with that reality, you stop forcing trades that just aren't there.
All right, number 4, the indicator overload, complicating your edge. It is so easy for beginners to overwhelm themselves. They're juggling the RSI, the MACD, Fibonacci levels, and looking at 5 different timeframes all at once. This leads straight into analysis paralysis. They get so overwhelmed with conflicting signals, they literally can't make a quality decision. On the right, though, you see what consistent pros do. They focus on stripping back all that noise down to one simple, repeatable, rules-based structure. Because here's the absolute truth. A complex combination of tools will never save you. You could have the most advanced secret indicator on the planet, but if you lack emotional control, you are still going to lose money. Your edge doesn't live in the software. The edge is entirely reliant on your internal discipline, your risk management, and your ability to execute a simple process flawlessly, time after time. And that leads us perfectly into our final point, number 5, the market mirror, or the failure to see your own internal state. It's human nature to look for external reasons when we fail. Beginners constantly blame the broker, an unexpected news event, or some mysterious algorithm for their losses. They fail to realize the market is just a mirror reflecting their internal state. Actually, 90% of failure in trading is driven by what we call the human glitch, our own emotional reflexes. Fear makes you exit a winning trade way too early. Greed makes you hold a losing trade way too long. And revenge? That makes you over-leverage after a loss just to try and make the money back. These emotional reflexes completely hijack your mechanical thinking.
So how do we survive this? Well, you have to ditch that temporary burst of motivation and build a serious internal process. It's about adopting a Kaizen mindset, which means continuous, steady improvement over time. You actually have to observe your emotions when a trade goes south, adjust your mindset, and actively build an identity rooted in absolute patience, profound humility, and brutal honesty with yourself. At the end of the day, profitable trading requires fixing the human before the strategy. Until you address your own psychology and patch up that internal human glitch, even the greatest, most profitable trading system in the world is going to fail in your hands. Trading isn't about mastering the market. It is 100% about mastering yourself.
So as we wrap up this explainer, I want to leave you with one final provocative question. Tomorrow morning, when you sit down and the market opens, what is your approach going to be? Are you going to keep endlessly searching the charts for a magic tool and blaming the algorithm every time you take a hit? Or are you going to accept the reality of the probability jar, demand real confirmation before you enter, and finally start fixing the human looking back at you in the mirror? The choice is entirely yours. Thanks so much for joining me on this explainer, and I'll catch you next time.